Welcome to the 2013 Burkenroad's Reports coverage of Conn's Incorporated. This is Jack Johnson speaking on behalf of my team, which consists of myself, Conn and Mehmet Sinar. Conn's is an electronics and appliance retailer traded on the NASDAQ as Conn, spelled C-O-N-N. Our team used a variety of methods to arrive at a rating of market outperform and a 12-month target price of $77, which I will discuss shortly. First, I will discuss our investment summary and the various methods we use to arrive at our target price. Second, I will describe Conn's as a company and the various growth strategies the company is targeting. Third, the various sources of Conn's revenue. Fourth, the retail and credit industries as a whole. And finally, our investment thesis and the various assumptions we made to arrive at our target price. Over the past 5 years, from January 2008 to November 2013, Conn's has a total return of 395%. The share price has steadily and rapidly increased since January 2011, shortly after a new CEO and management team joined the company. The new management team implemented a change in strategic focus, which has worked out well thus far and which we will describe later. The only significant decline in share price occurred in September 2013, following a disappointing quarterly earnings announcement. The major factor behind falling short of expectations was due to a sudden increase in delinquency rates on Conn's accounts receivable. This was explained by management as the result of a collections computer system error and has since been repaired. Nevertheless, the disruption displays any impact any changes in delinquency rates have on Conn's bottom line. To arrive at a target price, our team used a weighted average of 3 valuation methods. These methods relied on projected values, which we will discuss later in the presentation. First, we used the discounted cash flow method, which discounts our cash flow projections by the company's weighted average cost of capital. Second, we use the price-to-book value method, which uses a peer-based multiple with our projections for changes in book value. Third, we use the enterprise value to EBITDA method, which also relies on a peer-based multiple along with our projections for EBITDA. We then arrived at a 12-month target price of $77. Using a current share price of $61.51, we projected 25.18% 12-month return. Finally, we rated Conn's as a market outperform. Conn's is a retailer of home appliances, consumer electronics, mattresses, and furniture products headquartered in Beaumont, Texas. As of year-end fiscal 2013, Conn's has 68 stores throughout the southern United States, with a large majority in Texas. Conn's emphasis as a company is providing consumers with limited credit options access to financing, which it has done for over 40 years. At the end of fiscal 2013, Conn's had revenues of $865 million, net income of $52.61 million, and a market capitalization of $1.024 billion. We identified several factors which are important to Conn's revenue growth. In the retail segment, Conn's new product mix, with an emphasis on large, high-margin items like mattresses and furniture, generate greater gross margins and overall higher sales prices. This shift to the new product mix, implemented in 2011, significantly drives revenue. In the credit segment, Conn's in-house financing program is a unique competitive advantage in the industry. The majority of Conn's customers use the program, and it provides a stable income stream in an otherwise cyclical industry. Most of Conn's new store locations are selected based on the number of potential customers with below-average credit scores, and the company hopes to grow this segment as a percent of revenue. The services segment has declined as a percent of revenue and is expected to decline further. The figure on the left displays Conn's retail segment broken down by revenue. In fiscal 2013, Conn's 34% of retail revenues in electronics, 31% in home appliance, 20% in furniture and mattress, 10% in home office, and 5% in other. Conn's management hopes to increase the higher margin furniture and mattress category from 20 to 35% in the long term as they open new, larger stores. The figure on the right shows the usual method of payment by Conn's customers. 71% of sales are made through a Conn's account, with 15% through third-party financing, 11% through cash, and 3% through a rent-to-own program. For Conn's accounts, the company charges, on average, an annual interest rate of approximately 20%, and these finance charges are an important source of revenue growth. The recent disruption of collections discussed earlier shows the impact any delinquency issues can have for the company. Some major competitors within Conn's industry are retailers like Best Buy and Sears, as well as rent-to-own companies like Aaron's and Rent-A-Center. We evaluated the retail and credit industry as a whole using Porter's 5 forces. We found the threat of new entrants to be low due to the high upfront cost required to sell expensive products on credit. We found the bargaining power of buyers is medium, the bargaining power of suppliers is low, and the availability of substitutes is low. We evaluated the competitive rivalry as medium due to the relatively unique business model Conn employs and its lack of suitable peers. In our evaluation of Conn's, we made several important observations to inform our assumptions used in our projection models. Overall, we think Conn's will continue to grow as it shifts its business model to larger, higher margin products sold in larger stores. We expect new store openings and remodelings to drive revenues as they increase the company's overall square footage. We assumed a long-term annual store count growth of 10%, which is based on management targets for the upcoming periods. Remodeled stores, which gain square footage due to removal of office space, should see revenue increases of 20 to 25%. We expect Conn's to continue growing until it reaches a terminal value of 300 stores. We have identified this number using Conn's business model, which targets customers with a FICO score between 550 and 650. With 32 million Americans in that range, most facing difficulty obtaining credit, we expect Conn's to grow into 300 stores nationwide. This value accounts for customers outside the target FICO score range, using the range of Conn's current customers and their respective contribution to revenues. Over 2/3 of Conn's customers use the in-house credit program, and a significant percentage make monthly payments inside of a Conn store. This encouraged behavior limits competitors' ability to sell overlapping products to Conn's customers and limits potential threats to market share. As Conn's increases both store size and store count, the company offers more and more furniture and mattress. These are higher margin products with 43.8% gross margin compared to a retail average of 30%, and Conn's hopes to have the shift of the furniture and mattress category as the key driver in retail revenues in the short term. We took all these factors into account along with several assumptions to arrive at our target price and overall rating of market outperform. The Burkenroad reports are produced solely as part of an educational program at Tulane University's Freeman School of Business. The reports are not investment advice, and you should not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment. Thanks for listening.